You've probably heard about the 4% rule. 4% rule is what some CFP named William Vogan came up with a theory in 1993, I believe, as to how much money you could spend out of a portfolio and be assured you're not going to run out of money within, let's say, 25 years of a retirement. First of all, 25 years is becoming short for the typical retirement these days, as people are tending to retire early and tending to live longer. 4% meant as long as you took less than 4% of your assets, let's just say $1 million, as long as you lived on less than $40,000 per year, you'd be very high probability of not running out of money. And that took into consideration fluctuating interest rates and also ups and downs and random returns available in the stock market. Now, something happened since that rule came out, and that was the lost decade, the decade of 2000 to 2010, where had you retired during that decade or during the beginning of that decade, you would have found out that the 4% rule died. With two market crashes of over 50%, even a 60% allocation to stocks, 40% allocation to bonds would have seen so much turmoil and so much loss on the stock side, 4% withdrawal rate would have depleted those assets to a point where you would have failed in retirement. The new numbers, according to some experts in the industry, Wall Street Journal ads and Barron's did ads or did articles or had articles published that talked about numbers around 2.1% as being the new 4% rule. 2% rule, that doesn't cut it. If you have $1 million and you can only live on $20,000 of that and be assured of not running out of money, I believe that's a bad plan. Well, let me tell you that there's good news. Not only is the 4% rule dead, the 2% rule is also dead, because the 5 or the 6% rule is now reality. Companies that aren't Wall Street companies, that don't deal in risk, that deal in guarantees, that deal in security and insured accounts. We're actually talking about insurance companies that offer annuities that guarantee lifetime income no matter what happens in the stock market. They don't risk the principal of your money. They invest in a strategic way to guarantee returns that will guarantee that your money will not run out during your entire lifetime. Depending on your age, those payout rates could be 5%. And if you wait a little bit longer to take income, they could even be as high as 6 or 7%. So again, the 4% rule and the Wall Street rule is dead. Now, I'm not knocking Wall Street. There's still plenty of good upside. There's plenty of good growth opportunities. There's plenty of good stock investments there. But if you're counting on income, Wall Street products may not be the right place for you or may not be the right fit, at least for that guaranteed portion of your income. So let's forget about the 4% rule. Let's do a 5 or 6% rule. Does that sound better? If so, let us know. Call us and we'll give you a free report to see if an annuity makes more sense to you.